think we'll go ahead and get started. Thanks everyone for joining today. We have several of our Bonadio internal CECL team members on the phone, and then we have several clients. So if you do have a question, please just unmute yourself, state your name and where you're from, and we'll roll with that. We do have a slide deck prepared for today. However, I'm not sure how much of it we'll get through. We would rather answer your questions and have robust discussion. I will go ahead and send out the slide deck subsequent to the call, so you do have the information and everything that's included within it. So we did receive some questions, and we received some of those a little bit late, so I don't know if we'll have adequate or complete answers for some of those today, but any questions that are sent to us either before these roundtables or after them, we will go ahead and start a document that we will provide to everyone that will track the responses to those questions. So Aaron, Kafira, and myself will go ahead and lead most of the discussion today. So Aaron, do you want to flip ahead to the first slide there?
Yeah, no problem.
Okay, how about the one after that? So the first thing we thought we'd talk about before we get into some of the questions that we did receive was what we're seeing and hearing right now. So when we're out meeting with clients and talking to everybody about where they're at in their CECL process, everyone is obviously running parallel or either refining their models at this point in time. But we found that not a lot of people have prepared a lot of documentation to date. And I do think that this is going to be a very robust document that both your external auditors as well as your regulators are expecting to see. And I do think the other thing we've been seeing and hearing is that I think that when people have engaged third parties to assist in preparing the calculation, that they believe that sometimes the documentation of those third parties will fulfill some of those requirements. But I guess we just want to make sure to remind you that, all of the assumptions in the model are your assumptions. So even if the vendor, made choices, you have to support the fact that those choices were made and why you believe that those are accurate and support your institution. Also, we've been hearing that, as regulators are out doing their examinations or their quarterly check-ins, that they're also communicating with you what they expect to see as it relates to documentation, as it relates to the CECL implementation process. So anyone on the Bonadio team want to chime in on anything else that we're seeing and hearing right now?
I think their favorite words are always reasonable and supportable. So nothing definitive, but they want documentation for whatever we do.
Yeah, and I think I'll chime in a little bit too, just to kind of build on what Mark's saying. I know we see it on the audit regulator side. And so if we're seeing it on the audit regulator side, I would assume, and I think I can assume safely, that a lot of the regulators, like with the OCC and those DFS, are going to really be pushing on the documentation on these assertions and why they're reasonable and accurate and complete, and why various other components weren't considered or were considered and why you didn't use it. I think ultimately the documentation on this is going to be key. And then obviously once it's audited, from our perspective, we're going to be asking for a lot of that documentation as well. So it's not just going to be external auditors that are going to be looking at it. It's going to be a lot of different parties. So the more robust and more thorough and it will make everybody's life easier, especially yours, preparing these models down the road and in the future.
Yeah, and just to piggyback off what Aaron said, I think, one thing that you should take into account is you don't have to start from scratch for a lot of this. A lot of the times the vendors will have, many of the vendors will have information you can leverage for preparing this, or, maybe even do a lot of that work for you. So I wouldn't say that for the most part, if you are using a third party outsourced vendor to help you with your calculation and modeling, that you have to start from scratch. A lot of that information they should be able to provide you. But again, you have to make sure that that information is then tailored to the extent that it's for your financial institution. So that's where, your part will come in with regards to making sure that that documentation is suitable for your model and then the adjustments that you made, for it.
And I think too, I would expect to see this document revisited every year. I mean, would you agree with that? That, you revisit it annually to make sure that, because I know I've been talking to a lot of people now that are implementing using one method right now, and then may, moving forward as they have additional data, change the method for certain pools and so forth. So I do think this is something that you'll invest quite a bit of time in this year. And then moving forward, it's really just, gut checking it to make sure that, everything is still appropriate in nature.
And I think it also goes beyond just the model. I think if you're developing committees and that sort of thing to review your models as part of your internal control environment, you've got to take that into account as well. You may have to be updating a few of your policies and procedures with regards to the review function of that too. So I think there's a lot going on in the documentation world, not just at the assertion level, but potentially from an operational perspective too.
So Aaron, before we jump into the model development and implementation slides that we have drafted, why don't we touch base on the questions that we received? So I believe the first one related to the timing and review of the model.
Right. So yeah, so the question, I'll repeat the question, is from an ongoing monitoring of the CECL model. We are currently using a third-party vendor. And the question really is around what is the expectation for the model validation and back testing. So definitely a mouthful. And I think ultimately, I think it's going to depend on the complexity, and there's going to be a lot that goes into the overall testing and how often that's done. I think the guidance is still a little bit unclear as to if it's going to be annually or every 3 to 5 years. I think everybody's still working through that. And I think once we do some additional digging and analysis on it, I think maybe we can get a little more definitive of an answer, but I don't necessarily know if we have a hard and fast line in the sand as at this point in time, just given everything going on.
Yeah, I would think with the level of scrutiny that's expected with the adoption with so many institutions this year, that the expectation would be you would certainly do it this year. On a going forward basis, depending on the complexity, the risk, and the amount of beating up that the model you are using is getting, you may be able to scale back. But again, I would err on the side of conservatism at first and be doing it with the expectation of at least annually, and then move forward as we get more insight from the regulators and what they're going to really be expecting. I think any homegrown models would be expected to be analyzed every year. If you're using, a vendor model like an Abrigo or Warm or what have you, that one my guess would be that after the first year or so, they'll start to allow a more rotational review than being required to do it annually, because there's it's more standard, if you will.
Yeah, and I think also how often the assumptions are changed probably will drive that too. If you're not changing the assumptions, one may question why not. But putting that aside, I mean, if you're changing them on an annual basis or making significant adjustments to those overall assumptions, probably may have to, run the model again and kind of look at it from that perspective.
Okay, and again, like we mentioned before, we will send out the questions with responses, and we'll have links to guidance and so forth embedded in those as well. So another question that we received this morning was for financial institutions who have already implemented CECL, have you noticed any trends or changes to the coverage ratio? And then also, have you seen significant qualitative changes from the incurred loss model to the ACL? So what I'll say to that, and anybody else from Bonadio, please feel free to comment, is that I think we're seeing more variety in the coverage ratio than we saw previously, because I think we've seen some significant increases and we've seen some decreases. So whereas I feel like previously bankers typically had a coverage ratio in their mind, and everything hovered around that. I think that there's more diversification than there was previously. And then also as it relates to qualitative factors, yes, there's changes because inherently the new methods being used account for some of those qualitative factors that were previously not necessarily accounted for within the incurred loss models. And again, I think the bigger thing is too that we're really looking for and advising people to have some sort of direct connectivity between what those qualitative adjustments are and the basis for those adjustments. So does anybody else from Bonadio want to chime in on that? All right, and then we had an adoption question too, I believe, Aaron, but I think we'll just go ahead and respond to that one in the written follow-up because again, we just got that pretty late in the game.
We'll pull the guidance and include it in the write-up.
Okay.
To address that.
So do you want to go ahead and move on to so this is what we had for, I guess if we're looking at the overall model development and implementation documentation, these are kind of the main bullet points that we would expect to see. And we do, elaborate on each one of these throughout the slide deck. So, the purpose, design theory and logic, the judgmental aspects, data quality, flow and structure, testing and analysis, and lastly, third-party developer or software. And again, this is just focusing on the implementation documentation. As Aaron alluded to previously, you're obviously going to be updating policies. There's other documentation out there, which we can touch on, but the focus of this discussion was really just for the implementation documentation. So if you want to move ahead, Aaron, to the purpose. So I know a lot of the third-party models especially focus just on the loans, right? But we also know that this just does not apply to loans only. So just clarifying in your documentation, what is the intended use of the model, by whom and for what activities, and the business reason, as well as any decisions that are being made for the model.
And I think from a business reason perspective, one thing to keep in mind, and I know some of the guides out there discuss this, is that you have to look at your individual risks from a financial institution perspective. So I think that's important to make sure as you're considering the different models and the business reason behind it, that you're also considering the various risks that are specific to your financial institution.
Okay, so moving on to the design theory and logic. This is, I think, where a lot of the heavy lift is going to be. We have quite a few slides as it relates to this topic. So, you have to support why you selected the model that you selected, and then why you didn't select other models. I know in a lot of clients that we've been working with, people have run different methods, different scenarios, and documenting, why it's not appropriate in nature to use that. A big thing here on this that I think is extremely important is to make sure that, especially for these third-party models, that you're able to convey to your auditor or regulator how the model works. So making sure that you have a precise understanding of how each method that you choose to apply works. And again, any vendor, designated assumptions or choices that are made, make sure that, again, you can, as management, accurately convey to either your auditor or your regulator why those are appropriate for your institution.
And I think that's all coming back to the overall documentation to settle that and address all of that. So you'll probably hear it a lot as part of this roundtable today, is the fact that documentation. So it's nice to be able to beat somebody else up over documentation after being beaten up. And it seems like a lot of things that we do in the audit world is documentation. So welcome to our world. We'll give you a little taste, not that you really care or want to see it, but.
So then on this second slide, this is where I think we start dissecting, each individual method. So really looking at each input and again, making sure you document why those choices were made. So first and foremost, the loan pool classification. Why were those selected? You know, a lot of the models are using call report, you know, level of disaggregation. Why is that appropriate for your financial institution? So make sure that you're documenting that. Common risk characteristics. Which ones were considered? Which ones weren't? Why are they applicable to your loan portfolio? Make sure that's all documented. How did you ensure that all the information you have is complete and accurate? And then these models that are using publicly available information. Again, how was the information for that considered to be complete and accurate? I know we've talked about on the audit side, the fact that, you know, a lot of these models that do pull from call report data, if it's traceable, you know, and you can tick and tie it, that's great, you know, but you have to be able to have access to that level of detail to support the validity of that data that's being used.
Yeah, and I think from one thing to be cognizant of as you're going through these models, obviously a lot of this information may already be, it may be in your call report and in your financial statements, but as you're going through the process, if you are identifying different loan pool classifications, there may be a reporting element that you want to consider, and from a disclosure perspective in your financial statements, that maybe it's not different, that your users may not be used to seeing. Probably not going to happen very frequently, but definitely something to keep an eye on. And then obviously when it comes to using publicly available information, the more reliable the source, the better documentation, or the better information it's going to be. So obviously using like a Bloomberg or somebody like that versus using a website that I developed or something might not be as reliable, or it's Jamie and the team may not be as critical if you're using Bloomberg than if you're using information that I give you from my website. I don't have a website, but if I did, might not be very reliable.
Okay, so moving on to, I'll say probably the most significant factor, well, one of the most significant factors is the loss experience. So what were the various assumptions used to come up with the loss experience? Because there's a lot of loss or historical based models that are being utilized. And again, just ensuring that you're effectively documenting, you know, why you chose to use 3 years of data or 5 years or 10 years of data. And again, the level of disaggregation of that data and what significant assumptions were made as it relates to those. I know it's a little later in the slide deck, how recoveries are being treated within that data and so forth.
And I know we did talk about the, you know, how often are you evaluating the assumptions? That may be something you want to document in your policies and procedures and your operational guides. Again, I think it just will help the regulators understand your thought process more than anything else. And then you may wonder on this last bullet, it says what alternative assumptions were considered but determined not to be the most appropriate. Well, why would you have to do that if you said you made a decision and we're going to go on this path because this path is more fits the bank or the credit union, it's more our risk portfolio. Just documenting that thought process and conclusion, because somebody will ask, or it's potential that they'll ask, and that way you're ready to just address it and really show whoever's looking at it that you understand the models and the appropriate assumptions that are used within those models.
Okay, now the slide I think everyone's been waiting for, qualitative adjustments. So as it relates to qualitative adjustments, I think we're seeing that everyone is kind of still considering the same, I'll say, laundry list of qualitative adjustments. However, depending on the method that you select, like I mentioned earlier, some of those are frankly not applicable. And again, depending on the period of time that you use for your loss experience and so forth. So for each pool, what significant factors were considered and how did you determine them to be either relevant or not relevant? Again, just make sure that you're robustly documenting that. So then for anything that does result in a qualitative adjustment, again, like I mentioned before, how did you determine that qualitative impact? Is there some sort of linkage to, you know, a factor or if, say, for example, with inflation and what's going on right now, that you're saying that, well, in this sort of environment, we expect that if inflation is at, 7%, we expect, based on experience, delinquencies to increase by this much, and then that equates to some sort of basis point adjustment. So again, we're just looking for some direct connectivity, and I believe the regulators will as well. Any other comments there from the Bonadio team?
I think just making sure that it's accurate as well. I know we've got completeness on here, and the accuracy of the information is obviously also key. It's going to be key for all of your reporting, and definitely something to keep in mind.
And I think with the qualitative as well, I know some of the models incorporate forecast adjustments for the historical based methods that you can kind of like check the box. Again, just making sure you're not duplicating economic information that may already be accounted for in your projections. So I think a lot of those account for housing starts or unemployment data. So I just don't want to see double dipping into another economic qualitative factor on top if the model that you're using is already incorporating that.
Yeah, one thing I'd add is I know I've gotten some questions from institutions regarding the modeling coming from vendors and how some of those assumptions and qualitative, information is not necessarily aligned directly with what they feel they encounter as an institution. I mean, in those instances, it's perfectly acceptable to, make changes based on qualitative factors to the extent necessary to have your model aligned with your actual institution. Where I will caution with that is if you use a model from a vendor and you make qualitative changes to their information, be prepared to have it scrutinized. I mean, you have to make sure that it's adequately documented. Otherwise, you might not have, the regulators really buying into what adjustments you've made. So, while I would encourage you to not just take for granted what the vendor, has you put into that model based on call report data and what have you, at the same time, know that it's likely to get challenged, especially in these initial years from the regulators as they review your model. Because they'll be familiar with Abrigo, less familiar with whatever, subjective items you may have changed based on your particular institution's information.
Yeah, and I think where that's definitely been the case, and I've seen is some of the forecast adjustments are actually are making negative adjustments to the models. I don't know if anybody else has seen that, which I found to be somewhat unusual.
Yeah, absolutely. I mean, one thing I saw, especially with unemployment data, right? I mean, I saw, for instance, I think, some of the models were using New York's unemployment data. Well, New York's unemployment data isn't necessarily aligned with upstate New York's unemployment data. And in that case, it might be appropriate to make that change. And I think you would be warranted to do so. But again, as long as it's documented and well supported, I think you have, good ground to stand, any changes you make. But if you are not well documented and able to support those conclusions, I think you're going to definitely be challenged on them. So.
Aaron, I think, okay, yeah, you can move on to the next slide. So again, I would just expect if there's that list of 10 qualitative adjustments that you've, historically addressed, that for each one, I would definitely expect to see some sort of, for each loan pool, why it's either applicable or not, and then how that was, determined to be the adjustment that is required at that point in time. Okay, so moving on to the forecasting methods. Again, just making sure, I think, that you understand and can convey to your auditors and or your regulators how the math is working as it relates to those scenarios. And then as it relates to reversion, I feel like this has come up from what I've heard in a lot of the regulators' comments to make sure that you can explain how you've implemented reversion, and again, make sure that that's adequately documented within your materials. Does anybody want to elaborate there?
It's all coming back to documentation, as with all things in these models and everything.
And then moving on to slide 12, I know that this is something that I've really been looking for, and just ensuring that any assumptions you are using in your model are consistent with other assumptions you may be using at the financial institution. So I know for a lot of this information, since a lot of it is forward-looking in nature, I've been reading a lot of like the ALCO packages to see what assumptions are being used in that modeling. What about your budgeting and so forth. So I would just ensure that whatever underlying assumptions you're making within this model are consistent amongst the other models and so forth that you're using at the institution. So it doesn't look like you're obviously trying to manipulate the data to come out to a certain way.
One of the
Yes,
things where this comes up from time to time is when a lender operates in multiple markets and you have different approaches to things in different markets. I think it's more evident when you're in multiple states. So if you're in upstate New York, but you're also in another state, you just do things differently in different places. But then if you go to your CECL model and you apply the same factors to all of your loans, regardless of where they're from, that's an inconsistency in your overall approach. That's the kind of stuff we're talking about on this slide. So, and it's obvious when you're in multiple states, but it could even be multiple cities in the same state kind of thing. So the question of if you're in multiple markets, are you ignoring that and inappropriately ignoring it when you're looking at your CECL assumptions and factors? So don't forget about the multiple market idea if you're in multiple markets.
And Jeff, for that, have you typically seen the level of disaggregation at the portfolio level even greater, or how is that being applied typically in practice?
For larger lenders, they are creating pools that are different in different geographies. So, I was talking to one lender who operates in upstate New York, but they also have operations on the West Coast. So they're in California and Oregon. And to say that those markets are the same would be really challenging. I think that would be a stretch to say that, like, the mortgage market, for example, in those places is the same and they can apply all the same factors to all of that. So they actually did at the pool stage, establish different pools for some loan types to disaggregate the West Coast loans from the upstate New York loans and apply different factors and things to those throughout the entire process. I'm not suggesting that if you didn't do that, that you have to go back and start over all the way at the beginning with your pool establishment. However, if you didn't, you should, again, back to the documentation, the question is going to be asked, how could your loans in upstate New York be the same as your loans on the West Coast? If you don't have a documented answer to that question, that's going to probably be an issue at some point. So just be aware of that kind of thing. I would assume everyone is, but I think the question may even arise if you're based in Syracuse, but you also have operations in, let's say, the Southern Tier or something. Did you just assume that's all the same, or did you at least have some documentation about how the market might be different in those different places?
Yeah, and I think the other place this comes into play, Jeff, is, when you're purchasing loans, right? Purchasing portfolios of either, we see it a lot on like auto, obviously, or like recreational vehicles and so forth, out of market, and ensuring that you have that segmented and addressed as well.
Yes, exactly.
Okay, so I think we can move on to judgmental aspects. Do you want to pick up here, Aaron?
Yeah, I can definitely do that. So a lot of times with judgments, obviously, there's a lot of documentation that goes into it. So I'm going to reserve I won't preach and talk about documentation. At least I'll try not to. But just some things in this individual model that you have to consider, obviously, as you're going through it, is how you're evaluating the loans predetermined. And I know I will read a little bit off of the slide, so my apologies, but I think it's just definitely important to make sure that we're considering all these things. How are you managing the risk characteristic changes in your loan segment? I think we've touched on a few items of that with regards to inflation and potential changes in the economy within the individual area that you're providing these services, making sure that you're considering that as part of the overall model, as well as if you're missing any missing data, any incomplete data. What are you doing to adjust the model for that sort of thing? Looking at your overall forecast period, and is it reasonable? Obviously, if you have let's say like a auto loan, and you normally know those auto loans turn over in 3 to 5 years, and you have a forecast period of 7, somebody's probably going to want to know why, and is it reasonable, and is it appropriate? And it may not be. So you may have to adjust your model based on that feedback. And so obviously, if you document a rational reasoning, it will definitely help support your claim. And I'm not saying 7 years is the right number. It probably isn't, right? I think we can all agree on that. A couple other items to focus on here is, management determining how losses might be impacted by forecasted economic assumptions. Does it evaluate multiple scenarios? Can you predict COVID? I don't think you can. If you can, wow, you probably aren't working much longer because you're going to win the lottery tonight. Looking at the sensitivity with regards to these various scenarios and economic assumptions. Obviously, being able to pivot within the model is important. If you're seeing deterioration within your economic environment, that may be something where you want to reconsider some of your individual inputs at the time that you're starting to see that deterioration, which obviously would lead to the last bullet, which would be like a potential change in your methodology or assumption. Obviously, it's an estimate, so as the estimate moves along on an annual basis, you may be looking at this estimate and tweaking it according to what's going on in your specific environment.
And just to speak to that last bullet point a little bit more, I think one thing, I hate to say to caution everyone too, is I know no one would say this, but you don't just pick a method because it gives you the biggest number, that you're looking for. But also, I do think as you continue to refine your data set and, see what different results you can achieve with different methods, I do think that there will be changes in methods over the years because, people will find that there's methods that are, better to use for certain pools, and they just didn't have the data upon adoption.
And to Jamie's point, we're actually seeing lenders put that in their documentation right now. They're saying, we believe this method is appropriate because this product is only new in the last 3 years, so we only have 3 years of data. But as we go forward and we have better data, we're going to reevaluate that. And they're actually saying that now. They're not picking what their method will be in the future, but they're actually documenting that the choice they're making now is going to be reevaluated purposefully in the near future.
Any other comments on that or questions? Okay. That is not a picture of me on the slide, by the way, in case anybody's curious, with the beard and the ears. Okay. Anyway, data quality, flow, and structure. Obviously, there is a lot of information in these models that go into it. Some of that information, I know at the beginning of this, we did hear stories of financial institutions hiring an intern to just sit there and crank information on various loan files into the system that may not have had, so they could get appropriate data into the system. So I think considering, hopefully everybody on this call is well past that initial data input into the overall model. But obviously, as you were going through that process, hopefully you've gone ahead and documented what data you thought was relevant to be put into the individual models, as well as to the why of that information. Then that's going to be definitely something that will be looked at. Also, I think the overall accuracy and completeness of that information is going to be one thing that's scrutinized. Definitely, I can tell you right now, from an auditor's perspective, that's one thing that we are very focused on: is it accurate, is it complete, and why is it accurate and complete? And I'll give you a little bit of insight into that, in the sense of one thing that you can rely on is the SOC report for some of your operating IT. I'm going to use I'm not an IT guy, but in the IT, your operating IT environment does oftentimes have a SOC report that will cover a lot of these completeness and accuracy assertions, which will be beneficial for you to be able to support. How did you determine that it was complete and accurate? Boom, here's my SOC report. Boom, here's my documentation as to why I've utilized these informations as part of the file, or information from the file into the system, and it's complete and accurate. And here's why we believe that the inputs and the data and everything coming out is correct, because obviously bad data in gives you bad data out, which is something that we all want to avoid. Is it important? Is the sources relevant? Is there source documentation of that data in the relevant system? So obviously a source document, you may have a loan application. Is that appropriate? You're obviously reviewing those on a very timely basis, probably annually for a lot of you on this call. So it's a very robust process, and you're analyzing it. And so once it goes from source documentation into the system, you're comfortable that it's complete, you're comfortable that it's accurate, and you're able to flow it through and ensure that all the data for the various procedures that or periods that you're using is complete and accurate. Again, obviously, when we were first starting CECL a couple years ago, we were struggling with some of this information may not be available. How far back do we have to go? I think we're past that point, and hopefully we've gone ahead and documented where we've kind of initiated the cutoff and that sort of thing for the models used.
I think the one field I've seen more recently that may not have necessarily been subject to auditing procedures, and I think is the credit quality indicator. I know that, obviously for commercial loans or business loans, a risk rating is typically audited to ensure that it's appropriate in nature. But if you're using, for example, for consumer loans or residential loans, the credit score, and that somehow is updated on a monthly or quarterly basis by some sort of like third-party reporting, service, ensuring the integrity of that, or also the I know there's some of the models that are able to pull the values of homes based on the street address. So again, you would have to ensure the integrity of that data as well, especially if it's being used as an input to the model.
Okay. So just some additional questions to consider as part of the overall data quality and flow and structure. And one thing of interest is, I know we're talking a lot about the model and a lot about what's going into it, but one thing to keep in mind, and it's going to be right here on this, is what data is relevant to the pooling conclusion, e.g. loan type and vintage and risk rating term. Why is that relevant? There will be additional financial statement disclosures tied to the CECL model. So if you have a lot of this information already, such as the vintage, that will help you on the back end as you're preparing those overall disclosures. In addition to segmentation based on the call reports, if that's what you're utilizing, which a lot of you are, is how did you determine that overall risk characteristic, and is it appropriate and adequate with regards to your overall loan portfolio? If you are utilizing peer data, ensuring that it is a supportable assumption that you're utilizing, that it makes sense, again, based on your overall risk ratings, your overall pools, and your overall loan portfolio. A couple other questions on here pertaining to data quality, flow, and structure is, did management use or consider external data across the various loan segments? Also the pooling effect and the method selected for the data. And how did management determine that the framework is appropriate? So really going through and ensuring that there is documentation to support a lot of these questions, so that when somebody does come in and scrutinize your calculation and potentially your disclosures, that you're in a good position to just say, here's my memo, leave me alone, go away, and come back some other time. Lastly, here's what adjustments were made to adjust for missing or incomplete data due to system limitations or other factors. Again, for when we were initially starting out on this long CECL road, there was the concern that we've changed systems 5 times in the last 10 years. We finally have a good one, but maybe some of that data didn't carry over. What do we do now? And so documenting your thought process as to how to handle that missing data is definitely something that's relevant and important, and will assist in the overall analysis that's being done on that. Any other questions on that I covered? Okay.
Can I make a comment about the missing data? This has come up with a few lenders where they made a decision at some point on their CECL journey. It could have been 2 years ago, or maybe it was earlier this year, where they realized there was missing data or the data should have been more complete than maybe it is. And they elected to not address that. And so they just moved forward with data that they knew was not totally complete. Now that they're at the end of the journey or towards the end of the journey and they have a number, the number they don't believe is the right number. And they want to use a different method, but they can't because they never completed the data that would be required to use a different method. That's the kind of thing that you may be stuck in the short term, but you could still, this is the kind of thing where you might be able to address it going forward and change your method. And the reason for changing the method would be that you have more complete data now. So I think this is coming up more than I guess I wish it was in terms of clients realizing that the decision they made earlier in the journey to not fill out a piece of data that was not necessarily complete in their data set is causing the ultimate answer that they now are going to have to book to be not exactly what they wanted it to be, or not what they feel is really representative of the risk in their portfolio. And there's a sort of a regret level about not fixing that earlier. So that's something that unfortunately some lenders are kind of stuck with, something that maybe is not ideal, but that it's not too late to go back and fill in those data holes so that you can change your method in the future when you do have more complete data.
Moving on to the economic, I think is the next slide there.
Yeah.
So I think much like we mentioned before, a lot of these third-party models pull economic data. So just, again, making sure you understand what that is and the source of it, again, to ensure that it can be validated, or if in fact you're using it in your own, qualitative factors or models, to make sure that you have the sources documented and so forth, so it can be validated by a third party. So I think we'll move on to testing and analysis now.
Okay. So the testing is obviously something that we all know that this is where the kind of the rubber hits the road, in the sense that this is not going to be, you're never going to get it 100% right. Maybe you will. I mean, you can never foresee and predict every single loan and which loan is going to go bad and which not. So you do your best you can. And I think the overall documentation of determining the model that you're using, the performance to kind of test that model, and why you think it is the best and gives you the best guess, if you will, it's definitely important to make sure that you've considered that. In addition, when you're looking at the sensitivity of the models, the inputs and outputs, how did you conclude that it was correct, or did you make any sort of adjustments as part of that analysis and testing? And if you did, why did you make those decisions that you reached? Probably not incorrect, but why? But making sure that you are documenting those overall conclusions. And then also, if it didn't work right and you looked at it and you're like, wow, this number is just not correct, the model looks really, really bad, what did you do to address that and make changes, and kind of your thought process as you're going through it as to why you had to pivot, if you will, from a model perspective? Again, all just important things to make sure that you've documented your thought process down as part of this.
And I think where we're typically seeing that, and again, please chime in, anyone else, is where the loss rate is extremely low. Like, I know for residential, for example, I think that the loss rates are coming in extremely low because of, again, all the things we know about stimulus, the fact that things couldn't be foreclosed upon, that really no one missed payments because of all these programs that were in place over the past several years. And plus that, typically community banks and credit unions work with their borrowers to ensure that, they aren't going to lose their home and so forth. So if things just look wonky, like Aaron said, I do think it's completely reasonable in nature for management to document that. It's unreasonable to conclude that, especially given on what's going on in the economic environment now, that there will not be losses associated with a residential portfolio moving forward.
Jamie, is it also fair to say that many of us may not have the true life cycle of a loan in our systems in particular for real estate?
Absolutely. And again, because I think that a lot of people were using, or some of the data loaded was for a shorter period of time. So I definitely think that that is the case. And again, that's where you do make it up in your qualitative adjustment that you are making to those portfolios.
Okay. So if we kind of look at third-party developer or third-party software information, kind of documenting your overall thought process as to how you're going through, and you may probably already have a process in place for how you go out and seek bids on this stuff. Just making sure that you kind of look at who you used, why you're using them, was it appropriate, and were they transparent? Maybe even considering, do they have SOC reports? If you feel that that's helpful, if they provide you with third party information, kind of anything that's supporting why you think that they're the best fit from a vendor perspective to be utilized. And one thing that's even, as we're talking about the future and looking into the future, interestingly enough, is you kind of almost have to think about, what do I do if this vendor walks away and doesn't support the overall modeling of this anymore? Do I have appropriate systems in place to take that information and keep doing it offline in an Excel spreadsheet or something like that? My guess is probably not, but maybe you do, and maybe you have to consider that. So definitely a few things to consider, almost like a contingency plan in case everything does go south, unfortunately. So hopefully that won't be the case, and my guess is it won't be for some of the bigger ones, but you never can tell with what's going on in the world. So
I think this is the one place where most institutions have this documentation from, I hate to say, when they probably selected their vendor years ago now, the evaluative process that took place at that point in time. So it's really just, again, like Aaron indicated, updating it to ensure that, should the worst case scenario occur whereby that vendor stops providing the service and so forth, that you have a contingency plan as to how you will handle that if that occurs.
And one other thing to point out here is with regards to any sort of customization that they're doing for you, making sure you're documenting that customization, because the last thing you want is somebody to be looking at your model and being like, I know this third-party model very well. Why isn't it producing this sort of results? And the reason why is because you're customizing it for the right reasons, because it's specific to your financial institution. Just making sure that you've got that documented and considered as well as part of that. So I think that takes us to the end of our prepared, quote unquote, prepared remarks, if you will. At least it's the end of the slide deck. So
Go ahead.
I was just going to say, I know there was a question early on about what we saw with the early adopters and such. There were about 150 institutions that were required to adopt in 2020, based on the very large public banks. And when they adopted, and with the, call report for Q1 being about the same exact time COVID hit, it was a different kind of picture. But if you look at it going into 2020, the big banks and the small banks, the public data that's available from the FDIC, were right about at 120 basis points to the ALLL to loans and leases. Upon implementation, the big banks were in the 175 to 215 range. A lot of that had to do with COVID hitting at that time, at the end of Q1. And the smaller institutions were in the 125 to 145 range. As you go out to the end of the year, so that's about a 60 basis point difference in the ranges. As you go to the end of 2020, it was about 100 basis points difference. And then as COVID kind of settled and the losses shook out more realistically, they were back within about 25 basis points at the end of 21. And at the end of Q3 this year, they're still in that 25 basis point differential range. So the big banks were running about 155 to 170 at the end of Q3 this year. And the smaller institutions, 130 to 145. And generally, those are going to be the ones that haven't adopted CECL yet. So I guess I'd be curious to know if you're seeing your, as you're running parallel, your numbers more in that 155 to 170 range that the big banks have, or staying in that 130 to 145 range. And every time we've talked to people, they kind of want to know, like, what are you expecting? Yeah, can you give us a number? And I know they ask the regulators the same thing, and we always all have the same answer: reasonable and supportable, and fits your portfolio makeup and loss history and all that good stuff. But I'd be interested in hearing from some of the individuals on the call here. And not all at once, though.
Mark, and we can be sure to capture some of that data that you just shared when we send out the Q&A notes after this session. So, and I know we did have a question in the chat about when the slide deck will come out. So the slide deck will come out either today or tomorrow to the participants. And then, like we indicated, we'll have some sort of repository that we'll share with everyone where we can include the questions as well as documented answers that were either provided to us ahead of time or that came up on the call today.
Muted. I guess, my curiosity is kind of because I haven't really talked to many that are seeing much of an increase, and that's perfectly fine. But I am wondering if there are some out there. And then, we just a reminder, as always, to you do have the opportunity to bleed that into capital over 3 years. So you don't want to build up a buffer beforehand, because you are provided that regulatory relief there to phase it in if there is an increase.
Obviously, one of the things is that if you do come across questions or additional questions that you may have, I know we've got another one of these, and the information's on the screen right now. In after the first of the year, to make sure, just feel free to go ahead and send us these questions as you're thinking about it, and we'll try and definitely add them to the list of responses, and then we'll try and address them as part of the CECL Roundtable number 2 as well.
Yeah, and your questions do not have to be technical in nature. They can be questions for, other peers using the same software, and what did you do about this thing they're asking for, or something like that? Because we've seen a lot of those things, and we're obviously not down in the weeds entering data into the software and such.
So if there's no more questions, then thanks everyone for their time. We appreciate you participating, and we'll get that information out to you, and we look forward to seeing you in January. Thanks, everybody.
Thank you.